Living on dividend income is an increasingly popular strategy that not only lets you fund your retirement, but the suitable investment could possibly make you richer while sitting at home. Hello everyone and welcome back to our channel. Did you guys know that the average American has about $10,000 saved up for their retirement? Well, this amount of money isn't a lot, especially if you consider the rising expenses. But if this money is used to buy dividend-paying shares, then the situation could be very different. So, watch till the end to see all the income you could generate from $10,000. Have you ever thought of investing in an oil and gas company? Well, if you did, then ExxonMobil Corp is the right place for that investment. The leading oil and gas firms have had a problematic 7 years. Since the oil price collapsed in 2014, most energy corporations have had to decrease their payouts in order to stay afloat. The only exception was ExxonMobil. Despite a short-term drop in profits, management maintained its hefty payout. ExxonMobil continued to invest substantially in new oil, gas, and refinery projects as well. Exxon's offshore Guyana oil field in particular has become one of the industry's most important new energy assets. ExxonMobil is well positioned to benefit from the current rise in oil prices since it invested throughout the business cycle while most of its competitors cut down. ExxonMobil's income appeal, on the other hand, is as strong as ever. The dividend is secure even if oil prices fall to zero in 2020, and shares give out a hefty 5.7% yield. So, with an investment of $10,000, you guys will be getting paid $570 per year or $47.50 per month. Technology businesses aren't typically thought of as significant dividend payers by investors. There are, however, notable exceptions, notably in larger IT companies. Intel's enormous and reliable semiconductor business for personal computers and data center devices makes it a cash cow. While they aren't particularly fast-growing sectors, they are steady businesses that have benefited from pandemic-related demand. Meanwhile, Intel has taken advantage of its massive revenues to diversify into other more futuristic industries in order to supplement its main business. One of these, Mobileye, the company's self-driving unit, is a major driver for 2022. Intel expects to keep a controlling share in the company when it is spun off as a public corporation. As a standalone company, analysts say Mobileye might be worth $50 billion or more, representing a massive return on Intel's $15.3 billion purchase price just 4 years ago. Intel's capital expenditures will be reduced as a result, freeing up cash to reinvest in the core company or return capital to shareholders. Today, Intel pays a 2.7% dividend. That would translate into a $270 return per annum on a $10,000 investment. You can also look towards investing in a bank. The New York Community Bank Corp is a safe and higher-yielding bank for investors. The company is a specialist regional bank that specializes in multi-family financing in the New York City metro area. Even during economic downturns, the bank offers loans with a low loan-to-value ratio, guaranteeing that it suffers little losses. During the 2008-2009 financial crisis, for example, New York Community Bank Corp remained profitable and paid its dividend. In 2021, the bank's stock rose as New York City recovered from its pandemic-induced depression. However, a prospective merger with Flagstar Bancorp Inc. (FBC) was delayed, causing the shares to fall from $14 to $12.50. This is a stronger starting opportunity for income investors since the bank pays a 5.6% dividend yield, which would amount to around $560 per annum. Sticking to international investing options, Colombia's Grupo Aval belongs to the international banking sector. The holding firm owns buildings in 4 of Colombia's most well-known banks, as well as a Central American banking franchise and other Colombian companies active in infrastructure and concession assets, including toll highways. Crude oil accounts for over half of Colombia's export revenue. As a result, recent years have seen an economic struggle. Colombia, on the other hand, has roared back from the epidemic as oil prices have skyrocketed and the travel and tourist industry has reached 2019 levels of activity. Despite this, Aval is still down approximately 30% from its pre-pandemic levels, owing to the fact that foreigners haven't realized Colombia is on the rise again. Despite the company's recent announcement of record quarterly earnings, this is the case. Aval pays a monthly dividend of about 2.5 cents per share, or 30 cents per year, for a dividend yield of 5.5%. If you don't like investing in individual companies, then you can always look towards the S&P 500 index. This is popular because it gives you exposure to 500 significant US firms with a track record of stability and profitability. It's also well balanced, so you own a piece of each area and industry that makes up the stock market. Warren Buffett recommends the S&P 500 because of its long track record of positive returns. If you buy an ETF or index fund that tracks the S&P 500, you'll get a dividend yield of less than 1.5%. This is because many of the largest holdings are technology companies, which are known for paying little to no dividends. With a $10,000 investment, this index would only provide about $150 per year or $12.50 per month in dividends. The Dow Jones Industrial Average, sometimes known as the Dow, is another popular investment option. It is usually ranked second to the S&P 500. The Dow Jones Industrial Average is made up of 30 of the major US firms and is used as a secondary measure of how the US economy is performing. Investors might buy a fund that tracks the Dow Jones Industrial Average and get a dividend that is somewhat higher than the S&P 500, a little over 1.5%. Now you may be wondering if dividend income is the right move for you, especially considering the amount of return. Well, if you remember, back in 2009, most banks slashed or eliminated their dividend payouts, and these were the firms that were known for their stability and consistency. So, dividends are not guaranteed and are vulnerable to both macroeconomic and company-specific risks. Another disadvantage of investing in dividend-paying equities is that dividend-paying firms are not often high-growth leaders. There are occasional exceptions, but even if they have greatly outperformed the vast majority of equities over time, high-growth businesses seldom give large dividends to their owners. So now, the question remains, if not dividends, then what? Well, you can always consider income ETFs. Many of these funds invest in preferred stock, bonds, and other income-related instruments, while some specialize in dividend equities. They have built-in diversity as well. Income funds, like any other ETF or mutual fund, have high cost ratios that can affect long-term performance. Before investing, investors should carefully analyze a fund's portfolio, liquidity, turnover, and other risk considerations. Low-cost index funds provide the best return and the cheapest ownership costs. Another possible option is master limited partnerships. While they're a little more complicated tax-wise than most income investments, they generally provide a lot larger yield than traditional dividend equities. Because revenue is often derived from long-term pipeline contracts with energy producers, these returns are also quite reliable. MLPs are less sensitive to energy prices than oil and gas exploration firms, but they are nonetheless exposed to long-term industry trends. A sustained reduction in the price of crude oil or natural gas might result in smaller payouts. In addition to these dangers, increased interest rates may restrict capital inflows into the area, jeopardizing many issuers' development ambitions. However, our favorites for investment are our real estate investment trusts. REITs have enticing returns and inflation protection built in. While some section of the real estate market may be overpriced, there are a variety of REITs that offer exposure to various markets. You have the option of investing in residential or commercial real estate, as well as assets in various sectors or regions. Of course, REIT performance is influenced by the overall real estate market. Commercial REITs have struggled to owe to COVID-19 related shutdowns, but residential REITs have risen thanks to a combination of low mortgage interest rates and stimulus checks. By raising the cost of mortgage loans, rising interest rates might have a detrimental impact on real estate values. Investing is highly dependent on an individual's needs and preferences, but whatever you guys choose to invest in, we recommend that you do your due diligence so that you don't end up throwing your money away. And that is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please remember to hit that like button and subscribe to our channel. And on your way out, please do remember to click on that bell icon too, so you can remain updated about all of our future videos. We'll see you next time.